All right, guys, we're starting in a second here. Thank you for joining. Irfan, I think you want to unmute yourself.
Hi, everyone. Good morning, distinguished ladies and gentlemen. Thank you for joining Blockcelerate's webinar on blockchain winter, who will emerge in the throne in 2019. So far, it's been an interesting journey overall with blockchain industry, with massive buzz in 2017 and downturn in 2018. What does that mean? Was the industry a hype or a reality, which is yet to unfold? Well, this is a question we all seem to be asking, and we have among us Kate Mitzelmacher, CEO of Bloccelerate and Chief Transformation Officer of Consensus, Mr. Ray Valdez, who will discern and discuss about what to expect from the industry in the year 2019. Without further ado, please welcome Ms. Mitzelmacher.
Great. Thank you so much, Irfan. Thank you for joining us, everyone. As many of you know, this was a hell of a year for blockchain, the year of 2018. It started out with $600 billion in market cap for all digital assets, and then it came down almost 90%. And now it's at about $100 billion. So Ray and I thought before we go into the holiday mode, why don't we do a little bit of digging and data analysis to understand what has happened, what is happening, and what's going to happen in the future. So by means of introduction, as Irfan had mentioned, I'm the CEO and founder of Bloccelerate. Bloccelerate VC is a thesis-driven fund, and our hypothesis is that despite the market downturn, blockchain is poised to generate trillions of dollars over the next 5 to 10 years, and our goal is to invest in the best companies in order to capture a large percentage of that value. I'm fortunate to be joined today by Ray, a former colleague of mine of 10 years at Gartner. Ray is my inspiration and the reason I got involved in the space early. When we both were based in San Francisco, we used to go to meetups before the whole blockchain thing was cool. So without any further ado, Ray, why don't you introduce yourself real quick?
Yeah, thanks, Kate. Thanks, everyone, for joining today. Yes, those were the good times. 5 years ago, the small Bitcoin and cryptocurrency developer community in San Francisco. A lot has happened since. Now we're taking stock. Just a few words about my background. I'm currently Chief Transformation Officer at Consensus, which is the largest pure play blockchain company on the #1 blockchain platform, which is Ethereum. We're 1,000 people in 30 countries building different solutions, tools, infrastructure, providing services to government and large enterprise clients, as well as smaller ventures. Prior to that, I was 15 years at Gartner. So one of the themes you'll hear today is we've seen this movie before, and I've lived through multiple. I'm old enough to have the scars and to have lived through multiple boom and bust cycles, and that's some of the lessons that will be learned that we'll be sharing with you.
Great. So on that shortly, but first a couple of disclaimers here. Number one, this content is for information purposes only. Please don't use this and don't take that as investment advice. It is 100% educational. Number two, for content sharing purposes, we're going to go through about 45 slides in a pretty fast pace. So we'll make sure to share the slides with you guys on Twitter after this webinar. So feel free to find us on Twitter at Bloccelerate, and the slides will be uploaded there. And last but not least, as far as questions, feel free to tweet your questions at us, or feel free to use the Zoom chat room in order to ask questions.
Yeah, if I might add one other additional disclaimer is, and for today's conversation, I'm sharing with you my personal views, my personal opinions. They're not necessarily representative of my current employer or my past employer.
Great. So packed agenda today. We're going to go through quite a few things, but specifically what we lived through, where are we now, where are we going, what are we watching for, and who will emerge as winners. And as you'll see, we've prepared quite a few data points because I think data is worth 1,000 words. So first, before we jump into the details of the blockchain peaks and troughs. We wanted to see if there's some similarities in what we've been observing over the past 12 months with what has been happening with the internet boom of 1994 through 2002, but specifically the bust of March of 2000. And Ray, as you alluded to it, you've obviously lived through it. So maybe share your thoughts on some of the similarities.
Well, yeah, there was certainly the feeling of exuberance, and but also people knowing that that it is a bubble. There's an awareness that everyone is going, hey, this can't last. And it's also, developers were hard to find. I went through 4 .coms. In one, we went from 3 people in a coffee house to 150 people in 6 months. Our investors told us, you got to grow big at all costs. Hire 1 new engineer per week, which is pretty difficult to do in boom times, just like hiring blockchain engineers was 6 months ago, very difficult to do. And then 6 months later, they say, well, you've hired too many people. We don't have enough capital. We got to start laying off people. So some of the tragic and comic and ironic scenarios have been repeated. Again, we've seen this movie before.
So let's look at the details. During the internet boom, 2000, what was 2000 like? Well, that was about 10 years in since the commercial release of the internet. And in 2000, fewer than 300 million people had access to the internet, which equivalent is about 5% of the world's population at the time. With a 50K modem, the speed was about 7 kilobytes per second, and it took about another 20 years, so a total of 30 years of commercial web to reach 50% penetration. Another fun fact is that Amazon at the time had 20 million accounts. Today, Amazon at 304 million accounts. So this is a picture that is well familiar to everyone, especially the sort of vision is, I guess in hindsight, is perfect. But at the time, it wasn't so clear. So the dot-com crash of 2000 cost investors around $5 trillion. Why did the market collapse? Well, there's a lot of theories about that, but many investors foolishly ignored the key metrics, the fundamentals of investing, the fundamental rules of the stock market, such as analyzing profit-to-earning ratios, studying market trends, reviewing business plans. Sounds a little familiar, so we'll go into the blockchain boom in a second. And another reason is that analysis and analysts tended to overestimate the value of stocks. So for example, Yahoo at the time was valued at $125 billion, while it only generated 200 million in revenue. This is going forward, the same picture but extended. It took another 15 years for market to come back to its previous norms, and in 2016 it crossed the same valuations that we had in 2000. Now let's look at the blockchain. Blockchain also similarly had a lot of buzz and generated, many called it the panacea, solving all of the world problems and making the world a better place, though without realizing that it takes time for technology to mature and develop. So this is what we've lived through in 2011, in 2013, and 2014. So if there's one thing that stands out to me is that unlike the internet, blockchain has actually experienced quite a few bubbles. And each one of those bubbles at the time seemed pretty catastrophic. And it seemed at the time it's not going to come back. But if we go forward, this was the 2014 bubble that we just saw in the previous picture. It seems like a glitch compared to what we just noticed in 2018. And our prediction and our expectation is that most likely we're going to see this 2018 bubble as the glitch compared to the next bubble. But one thing to keep in mind also, I mentioned that internet bubble has taken about $5 trillion worth of investors' money. Compared to that, blockchain bubble is about 10% of that, at about 500 billion. So it's 10x less, though the buzz seems to be quite similar. Ray, do you have anything to add to that? You're on mute, Ray.
Sorry, to underscore some of the points is that it's really a fractal curve, and that's the difference between the Bitcoin curve and the one that we saw for NASDAQ tech stocks, is that when you're in that little bubble of 2013, the peaks and valleys look very high, but then over an extended time frame, as Kate pointed out, it's only a little bump on the road. The other lesson, though, is that after the crash, after you go from the peak down to the valley, it takes some time. It's not going to recover slowly, and that we saw from the NASDAQ curve as well as this cryptocurrency curve. Another lesson is that we've been focusing, our conversation here has mentioned Bitcoin a lot, but that's a proxy for all the other cryptocurrencies. If you look at the curves for any other currency that you care to look at, you'll see that the charts are very similar. There are only a very few exceptions. There are some small opportunities for arbitrage, but pretty much they're all following the same curve. And that's part of the mania where people would, in the .com days, people would buy Sun Microsystems or Intel stock or some other stock, and they think they were smart because the stock went up 5x or however many x. But it's not being smart. It's that everything was going up. The rising tide lifts all boats, and then when the bubble goes down, all boats go down as well. So.
Right. Yeah. So as Ray alluded to that, but if we compare it with the internet bubble, and it took 15 years for the internet, for the stock market to correct itself, we expect the blockchain to take much shorter time. Just looking at the previous bubbles, it was much shorter period of time. However, it doesn't immediately sort of correct itself as many expect. So what are some of the reasons for setbacks? Well, there's a lot of theories out there. We're not going to go into all of them, but certainly the uncertainty of the regulatory market is not helping. Speculation, many argue, is what's been driving up the price and what is driving down the price today. Governance challenges, specifically challenges within the BTC core development team itself, as well as many other projects, are really struggling to grapple on governance. Weak infrastructure. At the time, many of you know that infrastructure currently doesn't support the enterprise-grade level applications running hundreds or not millions transactions per second. Lack of knowledge, poor user experience are among few, and last but not least is in the enterprise side. While Ray and I were both at Gartner, we actually tracked 100 POCs that enterprises had implemented, and 99 of them failed to meet business outcomes. And there's a number of reasons for that. Maybe Ray, you can shed some light on that.
Yeah, so one of the things that I noted when I was at Gartner, and it's still, that pattern persists, that was 2 years ago and it persisted over the last 2 years, is that, yeah, of the POCs, and there's now, pretty much, I'd say 80% of the Fortune 500 companies have done a blockchain POCs. Many of them have done more than one on more than one platform, 2 or 3 different POCs. 99% of them have failed to move beyond the POC stage. They've failed to leave the innovation lab, failed to go into production in real world system. And part of that is that they weren't really addressing a real business problem. They were addressing what we call the CEO problem or the board of directors problem, where they read in the Wall Street Journal or on Bloomberg News or some other news source that everyone's doing blockchain. And the reality is that no one is doing it for real, or almost no one. and they go and tell their CIO, we got to do blockchain, and then they call up and say, well, what do we need to do blockchain? What are use cases? So that's anyway. Now we're getting to more reality of understanding what blockchain technology is good for, where it aligns, what real world business problems it can solve, and that will be a good thing as that continues to happen.
Right. Well, Ray was actually smart enough to predict this winter some time ago, about 20 months ago. This actually is the slide that he was presenting on at one of the conferences. Was it end of 2016, early 2017, right?
Yeah, in that time frame. I did. I started talking about it a bit in 2016, but then I had the slide in January 2017 saying winter is coming, and then the label blockchain winter. Now I was actually at a conference in Shanghai last week on blockchain, and the keynote speaker talked about blockchain winter, and there's others that I've seen talking about blockchain winter. So that's a common theme these days, and rightly so. But we called it, and the reason though it's not just me, it's that it's a natural pattern that follows the Gartner hype cycle, which resembles the boom and bust curves that you saw for NASDAQ and for Bitcoin cryptocurrency. So it's, again, a technology initially is not very well known. The early adopters start checking it out. Then everyone gets excited. There are articles in the press saying that it's going to solve all our problems, or people have that expectation. Then they actually start working with it and do POCs, and they realize that actually, no, it's not quite ready, it's not mature, or they misperceived what it was good for. And then you go to the trough of disillusionment, the valley of disappointment, where then you will see articles saying this thing is not good for anything at all. And we do see some of those as well. And the reality
tend to go to extremes.
And the reality is that this is the curve is about subjective opinion, perception, that there's a separate curve that's a steady linear growth of the capabilities, the foundational capabilities of the technology. And as the perception and reality get into alignment, that's when you go to the slope of alignment and the peak plateau of productivity, which will start to happen in the 2019 and 2020 timeframe.
Yeah, so roughly you would suggest 18 to 24 months, correct?
Yeah, that's what it's looking like now. It depends on how much cold water gets thrown on people's expectations, and then they shake it off and start looking around at the real world without the rose-colored glasses.
Right. We'll have to hold another webinar 18 months from now. Check on your predictions. All right, guys, so now we're moving on to more details on what exactly have we lived through, and we'll skip to the slides rather quickly just for the sake of time. So number one, everybody measures the success of the space by the amount of money that goes into it. And to many of you, it's not a surprise that the ICO funding is dramatically going down, especially end of this year. However, if you compare total amount of funding with last year at $5.8 billion and almost 913 projects, it surpassed that number in 2018. With $12.3 billion and almost 1,200 projects. Another interesting proxy is to look at the graphs of the GBTC, the Bitcoin Investment Trust, that is a trust offering opportunity to bet on Bitcoin by buying its shares to both retail and institutional investors. And GBTC Investment Trust lost roughly $4.2 billion in value from the beginning of this year until today. As a miner myself, I always pay attention to the revenue graph of miners, and it peaked in last December 2017 at $41 million, and it's down to 6.2 million in rewards paid today. Transaction fees are sort of following a similar pattern. As a result of that, NVIDIA shares, NVIDIA, for those of you who don't know, is the most prominent popular graphic cards manufacturer that is been benefiting from the blockchain and the mining boom. And its shares have gone down 40%. And that happened with a delay. It only started coming down in October of this year, and it peaked in October at about $280 per share. Last but not least, trading volume is down in 2018. What does that mean? Well, that means that we're going to see a lot more crypto exchanges going out of business, most likely not the ones that we know and heard about, the likes of Coinbase, and I'll explain why, but there are hundreds of exchanges in the market today, and their margins are getting squeezed as the trading volumes are going down. So where are we now? What are some of the trends that many are not talking about? Everybody talks about the negative data points, but let's look at some of the positives. Ray, I'll pass this one on to you since you're representing Ethereum ecosystem, and you're on mute.
So one thing that we're seeing is that developers continue to adopt blockchain technology, experiment with it, and build solutions. I was just the month at the beginning of November, I was in Prague at DevCon 4 conference, the primary Ethereum conference, and it was up 3 times growth, 300% growth over the year before. About 8,000 developers, and there's probably about 300,000 developers in the ecosystem. There's Truffle is the developer framework that's used by 90% of smart contract developers on Ethereum. They have 1.2 million downloads, and I'd say that's not quite one-to-one to developers, because many developers would download it several times. We have anywhere from 300,000 to 500,000 developers, and that's a very robust growth. And the thing about developers is they're not necessarily motivated by money. I mean, we're all motivated by money, but they're not looking to double their holdings in 2 weeks or 2 months. Many of them, actually, I know personally, are not, they're focused on the intellectual challenge or in solving a real world problem. And this is a very healthy indicator. It's also helping the ecosystem, the platform grow, because as developers build different kinds of solutions, from whether it's a game like CryptoKitties that puts a certain kind of stress on the technology platform, or a medical record system, or a land title registry, these will stretch and make the platform get stronger as the platform evolves in response to that. So it's a very healthy indicator.
Yeah, so just on that note, in November, the Truffle downloads finally crossed 1 million, which is quite a significant milestone. And since then, 200,000 downloads had happened. MetaMask had passed 1 million, and there are more than 12,000 live Ethereum nodes today. Another indicator of where we're going is this interest from and growing interest from global nations. So more than 90 central banks have announced their plans to experiment and test blockchain technologies, but hundreds of countries are proactively adjusting their regulations to attract blockchain talent, as well as doing live POCs on the blockchain. So some examples here: Japan's e-voting system that is going live, Dubai 2020 initiative, Japan's e-voting system are some of the example. And to me, the public sector in general and the government seems to be one of the, if not low-hanging fruits, then an opportunity to capture immediate value, because in the world of diminishing trust, blockchain is most useful where trust is missing. And trust seems to be missing in a lot of developing nations.
Yeah, I'd like to add just another data point there. Just a few weeks ago, I and colleagues from Consensus were at the Smart City conference in Barcelona, Spain. There were 20,000 attendees, paid $1,500 fee, 800 cities represented from all over the world, 200 mayors, 700 vendors, 20% growth over last year. And this is not about blockchain. Blockchain was only a tiny part of it, like Dubai, which is a Consensus project, was there. But in general, these are real people struggling with real world problems across the planet, urban scale problems having to do with traffic, pollution, crime, governance, energy consumption, healthcare, real problems, and they have real budgets to try, to some extent, to solve these problems. So that's a growing area, and blockchain can help in certain aspects. It's not a panacea, as many real-world problems are often a combination of economic, social, political, and cultural factors, but technology can play a beneficial role, especially as Kate pointed out, where we are in a world of diminishing trust. So technologies that enable trust in a trustless context will be increasingly valuable over time.
Yeah. Another interesting indicator that is following the exponential curve is the number of blockchain wallets, which is a sign of growing adoption. As of Q3 of 2018, we reached about 300 million wallets, which is still a small fraction compared to the adoption of the internet in 2000 with 300 million users. Still early days, but demonstrates strong signs of adoption. Coinbase. Well, despite the downturn, the Coinbase downloads are on the rise. Number of users is going up, not down. And in 2017, actually, Coinbase became the #1 most downloaded app on Apple App Store, which is another sign of consumer adoption. While ICOs are going down, STOs are on the rise, and they sort of fulfill this gap at the moment, or sort of an intermediate step for companies looking to raise money in a more legitimate fashion. So we're seeing this, and we're continuing to track and expect more STOs in the 2019 timeframe. And another interesting data point is that while ICOs are going down, the VC funding is not. The VC funding is actually going up. It's at $1.6 billion for 2018. Some of the notable deals are Robinhood at $250 million, Circle at $110 million, and Ledger at $75 million. But as an investor myself, it's quite encouraging to see that some of the large institutional money is starting to pour into the space with announcements from big endowments like Yale and Stanford and Harvard allocation towards crypto VC funds. Another interesting observation is incumbents such as Facebook might start taking advantage of this bear market by sweeping up some development talent that is not able to stay within the startup ecosystem given the downturn. So Facebook recently launched a 30 to 40 engineering team to launch a crypto offering. Most come from PayPal, but include other relevant backgrounds, as well as looking to add the crypto payment component. Though I think both Ray and I are quite skeptical on this notion.
Yeah. So yeah, one thing, there's a difference. So there are different patterns of adoption and in different regions. In North America and Europe, we have the internet giants like Facebook, Amazon, Google have largely ignored blockchain until recently, and now there are initiatives underway, including companies like Salesforce.com. These are all relatively recent. In contrast to, say, in China, where actually the internet giants in China like Tencent and Alibaba and Baidu have actually been working on blockchain for several years, 2 or 3 years, and they have their own blockchain technology they've built. So there'll be an interesting dynamic over the next few years as the Western internet giants will build out their platforms, and they will collide out on the planetary scale with the Chinese internet giants that are looking to expand outside of China onto the world stage. So, but one could say that who will win there? Possibly none of the giants, because if you look at the web era where you had Amazon, Facebook, Google as disruptive new companies that grew big, almost $1 trillion valuations, by disrupting existing players in the old pre-digital economy, one could make a case that there will be new giants in the blockchain era that won't be the current generation of companies, because it's often very difficult for companies to think outside the box, to think of the new radically decentralized concepts. And we go beyond that. Kate and I have published on how it's possible that there will no longer be trillion-dollar companies the way Facebook and Google and Amazon are. Instead, we'll have trillion-dollar ecosystems, because blockchain, through its radically decentralized nature, changes the economics of the firm, changes the rationale for having transactions within a particular container, a silo of a corporate entity. And instead, you'll have trillion-dollar ecosystems rather than trillion-dollar corporations.
Right. So who will disrupt the disruptors? That is the billion-dollar questions. Another interesting, I guess, event that happened recently is Overstock.com, the retail giant, to many of you who know, has announced that it's selling its retail business and going 100% crypto. The stock has surged 26%, though I think this is more of an example of a declining company trying to save itself through the new shiny tools such as blockchain or crypto, rather than an example of any particular innovation per se. And last but not least, despite the downturn, Coinbase is about to hit $1.3 billion in revenue this year, which is a significant amount, even despite the declining market. So with that,
just to add one, before we go further, Kate, just one quick point is I see parallels between the early days of internet and web adoption and the role that Coinbase is playing today in the crypto space. So in the early days, the user experience was really horrible for the average person. They had to install a device driver for TCP/IP. They had to wrestle with their modem. They had to then navigate through unfamiliar websites that each had their own way of doing things. And AOL really filled a huge need by providing a quality, consistent, stable user experience and support and handholding for the people newly entering that technology domain. Likewise, today, the crypto space has horrible user experience. You have to know about private keys and public keys, and the problem is if you make a mistake, you lose all your money. And Coinbase is a centralized system that's sitting to the side of the public blockchain that's supporting it and providing a quality user experience. My personal view is that's probably a temporary role that just like AOL faded because the user experience got better. Here, an indicator going forward of really mass adoption and mass success of blockchain will be the quality of user experience in the foundational technology for the average user. And we have yet to see that, but we expect to see that. That will be necessary to go away from blockchain winter to blockchain spring.
great. So what are we watching for going forward?
Yeah, so, and then talking about going forward, it's important, you know, in discussions, people tend to conflate various related concepts, and I'd like to just spend a minute just presenting some distinctions. There are different kinds of roles. One is digital gold, which is similar to physical gold. It's a store of value. it's somewhat speculative in nature, but you're not expecting to double your money in 2 weeks. You're expecting it to grow over 6 to 12 months or longer time frame, because it's the transaction cost, the friction, the process of acquiring digital gold or physical gold for that matter is there's a high friction. So once you've gone through that, you're not going to go buy a cup of coffee with digital gold. Likewise, there's digital cash, which is the aspirational vision, where you would go and get the $3 cup of coffee and pay for it with crypto. And I don't think, my personal view is that's unlikely to happen in the next 5 years or even longer, because the current platforms are not scalable, the user experience is terrible, but also that there's plenty of alternatives. In China, they're already in a cashless society using WeChat Wallet and Alipay. And here in the US, consumers, when you go to the checkout counter, there's like 10 different logos and icons for Apple Pay, and not to mention credit cards. So I don't see digital cash, despite the aspirations of some of the crypto advocates, playing a major role. We have cryptocurrency tokens, which is fool's gold, which are the ICOs that we've all seen collapse over the last recent months. And that may evolve to something different, like Kate pointed out, with STOs. And lastly, we have blockchain platform that we're really still just getting going. This is where developers are building real solutions for real problems, not necessarily financial transactions. It could be a medical record system. It could be an identity system. It could be supply chain management and provenance system, and so on. And we're just getting started on that. Next slide. So what will determine the long-term success of technology is when expectations get into alignment with the reality of the technology and really align with the core value proposition that's delivered by that technology. In the case of blockchain, it's decentralized trust, having a trusted record in an untrusted environment of potentially dishonest actors. Thousands of businesses need to do business with each other. They don't know each other, don't trust each other. They don't even know of each other, but they want to do value exchange. And beyond value exchange, you get the immutable record of significant events. So not just the financial transaction, but valuable information like a property record, an identity record, a medical record, other kinds of valued data in the digital domain. And there's also a correspondence with possibly physical assets in the physical domain. And lastly, there's the smart contract platform, such as found in Ethereum and other platforms that have this dynamic programmable behavior that's tied to transactions and to other events at a very fine grain, doing that self-enforcing business rules that govern business exchange that don't require appeal to an external party like a government, like a judge, the legal system, paper records, etc. So this is what's going to determine the long-term success. There are, as I mentioned earlier, Ethereum is the #1 platform among smart contract platforms. There are more than 90, there's 90 or to 100 plus competing platforms that are all looking to address limitations in the current generation of scalability and privacy and maturity of tools. And people ask, who will win among these competing platforms? And my answer is the one that's not yet on the market in its current form. So it won't be Ethereum 1.0, it could be Ethereum 2.0 or 3.0 or a competitor. The rationale for this statement is that if you look at the history of other sectors, like internet search engines in '95, you had Alta Vista and Yahoo and others had tens of millions of users in production, and Google came later and won. Social networks in 2003, MySpace had 100 million users, and others had tens of millions of users in production, and Facebook came later and won. Mobile operating systems in 2007, BlackBerry and Nokia had hundreds of millions of users in production, and iOS and Android came later and won. And now we have the blockchain space where we have maybe 15 million users across all platforms and cryptocurrencies and exchanges. And my point is that even if we had 100 million users in production, you could make a case that it's still early and the one that will win will come later. And it could be one of the current players, but it will have to evolve beyond the current limitations in scalability and privacy and flexibility.
Great. Another sort of expectation of ours is that blockchain is going to solve the privacy paradox. What is privacy paradox? Privacy paradox is when what tech companies are facing today, and that is the sort of balance between providing a better consumer experience without violating consumer privacy. But as we have seen, the number of data breaches is going up. The value of personal data is becoming more and more important, and the chart that you can see here is that value of data going up significantly through 2027 to reach $103 billion. And blockchain is well positioned to solve this problem for a number of different reasons, such as providing self-sovereign identity mechanism, private data storage, etc. And for example, one of the most popular browsers, decentralized browsers, Brave, that is trying to disrupt the likes of Chrome and Internet Explorer, has recently reached 4 million, I believe, daily active users over the past couple of months, a clear sign of adoption. Another trend that I'm personally very excited about, and there's not enough data to back this up yet, but this is more of a hypothesis of mine, is that we're going towards democratization of value capture via alignment of incentives. So if we go back 100 years ago and look at companies such as Carnegie Steel, Ford Motor Company, the Rockefeller, Standard Oil, majority of equity of those companies was possessed by the owners, almost 100% of it. If we fast forward 5 to 70 years to the internet era, we have about 50-50 split between the owners of the company, the creators, and as well as employees, and 50% VCs, so the cream of the crop, the elites, who got a chance to participate in the value capture of companies. What we're seeing with blockchain is the reverse of what we saw 100 years ago, where only 10%, if not less, of companies' ownership or equity is retained by the team, and 90% of it is shared with the consumers, with investors, with adopters, with broader public, and that is a really exciting trend if it actually comes to fruition. As I mentioned earlier, we're a thesis-driven fund, and this is the hypothesis that we have put together about a year ago, and we called it the 3 phases of blockchain development, from block storming phase, that is the current state of the state today, where this philosophical shift is happening in the technology, and that results in a huge number of innovations, though those innovations are not quite ready for mainstream adoption, and that is predicted to last 1 to 3 years. The second phase is the block forming phase, and that's really over the next 3 to 5 years. Some of the clear winners are going to start to emerge, and then moving into the block norming phase over the next 7 to 10 years, when really some of the more clear, I guess, winners in the ecosystem is going to become more saturated and stabilized. And that's when we see the prices sort of reach its more stable values. And just a quick note on that, we always underestimate what we can accomplish in 10 years and overestimate what we can accomplish in 1 year. And I think this is a good example of that. Ray, do you have anything to add to that?
No, but there, I believe, commentary on this slide, which is estimate of the value out of blockchain. This is actually from Gartner last year, 3.1 trillion by 2030. So this is a conservative estimate. I just saw this week, different company had a different estimate of same number, 3 trillion by 2025. So regardless of whether it's 2025 or 2030, there's significant business impact that's going to occur across many regions and many sectors in different use cases. And it's going to take some time. One thing that this chart doesn't show you is that it's showing you where the hockey stick curve starts to really kick in. But prior to that, there's a slow, gradual rise from 2018 to the 2020s decade.
Mm-hmm.
Next slide.
And I think worth just mentioning here on this slide, the distinction between what we talked about in terms of digital cash versus the smart contract capability, which I believe is portrayed in green, correct?
Yeah, so there's there are different aspects, whether you're talking about more primarily for record keeping, more for dynamic value exchange. So yeah, there are different roles, different sectors. So behind this chart is actually hundreds of rows in a spreadsheet that is looking at different sectors, different use cases, and different regions.
Mm-hmm. So what are some of the key takeaways and lessons learned that we have to share with you? Well, number one is that while popularity, which in our case community matters, the popularity does not equal profit. So rather than focusing on which companies have the most buzz, it is better to investigate whether a company follows solid business fundamentals. Long-term investments have to have strong revenue potential, and that is related to number two, which is distinction between speculation and fundamentals. Fundamentals have matter today and will matter in the future. Try to avoid speculative mania and focus on those fundamentals. Try to analyze the business models, and most importantly, customers. We often forget that business would not be possible without customers. So asking a question, who is your customer, or who is the customer of the company that you're investigating to invest into, is a really, really important question. Number three is that technology progress is not linear, it's exponential, but it takes time to develop. And oftentimes human emotions and our expectations get ahead of the curve. And it takes time to build things. Number four, it's not a war for tech, it's a war for talent. It is not whoever gonna win the scalability war in Ethereum or any other platform, that platform is going to win. It is whoever is gonna get developers to build on that platform. That is the platform that's going to win. And last but not least, first doesn't mean best. And that is what Ray alluded to earlier. There were many search engines, and then Google came and won. There were a number of social media networks, and then Facebook came and won. So what we're seeing today with Coinbase dominating because it's solving a UI problem, it doesn't mean it's going to win in the long run. And that's just something to keep in mind.
So who will emerge with the throne in 2019? Well, as we said in today's conversation, after the descent from the peak to the valley, it can take a while to a slow ascent, slow rise to get back to where we were before. So it may not happen in 2019. It could likely happen elsewhere. But another thing to mention is I'm old enough to remember the days before computers in offices were connected over a local area network. There was the Ethernet first came out, connecting PCs that were previously siloed stations where people just worked on spreadsheets by themselves. Well, people got excited. As with any new technology, there's the early adopters, the people who see the potential, and they said, wow, this is great. Soon every computer will be connected. And people said, okay, the year of the LAN is going to be next year. And that didn't happen. And then people said, okay, the year of the LAN will be next year after that. And that didn't happen. And then one one day, not long after that, people woke up and realized that the year of the LAN was the previous year, that it had already happened. All of a sudden, every PC in every office was connected to other systems doing useful, productive work. So likewise, here, people talk about, whether you're talking about digital gold, digital cash, or blockchain platforms, who're saying, yes, it's coming, the blockchain era is upon us, etc. And then people are disappointed it's not pervasive. But I think in just a few short years, we're going to wake up and realize that it had all happened the year before.
Yeah, and just a great quote to sort of summarize that is that the speed of technological disruption is accelerating, and it took almost 80 years for Americans to adopt a dishwasher, while the consumer internet became commonplace in less than a decade. And it's very much possible that even further acceleration is going to happen in the blockchain space. Though instead of focusing on 12-month increments, I think we should be focusing on solving key problems, looking at key indicators, and then we'll notice that actually last year was the year of the blockchain. So with that said, I'm going to open it up for questions. Just another note of inspiration here is the night is the darkest right before the dawn. So we'd like to open it up for question, guys.
I see a question in the chat saying, what's your view on new startups combining blockchain and AI? One problem with smart contracts is to write a contract that lasts forever and can't be chain retrospectively. AI might help and maintain more robust and useful smart contract applications. Are you looking at any companies that do this right now? So I'll talk about some of the issues, and Kate, maybe you can address some of the investment aspects. So blockchain and AI, I see that a lot. I go to conferences and I see people talking about not just blockchain and AI, sometimes they add a few more buzzwords, blockchain, AI, and IoT. And in my view, those are all separate and not really well aligned at this point. Blockchain is currently, it's a very limited flat file database that has simple records not a lot of data in each record and very simple data model. AI is about complex relationships among data, and that is hard to model on a blockchain. So it's not, I don't see that happening anytime soon. AI itself they've made great strides in very limited domain, and it's accelerating. It's going to have an impact, but I think it'll be a few more years before there's a real genuine connection between AI and blockchain. Now, one other aspect that's alluded to in this question is the problem with smart contracts, which I very much agree that it's a huge problem. I think that all smart contract technology is obsolete or should be obsolete today. It's dangerous. It's using legacy languages. Even on Ethereum, your people are programming in Solidity, which is basically, I consider it a legacy language because it's effectively similar to Java or JavaScript. So we need new programming models, new tools. I don't think they necessarily will be AI. It could be other kinds of tools that ensure the correctness of programs. There are domain-specific languages, there are declarative languages. I think those will have perhaps more of an impact in making smart contracts safer and easier to write correctly than AI will. Because the reason I say that, I don't see AI playing a role in writing regular programs. So there's the general program of software development that people have been struggling with for decades. And AI has not played a role in conventional programs. I don't see AI playing a role in smart contract programs. Kate, anything?
Yeah, no, I'm trying to get my head around this question because I think it all depends on the use case. For us, we looked at a number of companies that are combining blockchain and AI for very different purposes. And I think this question is specifically about changing the smart contract retrospectively. Well, the point of the blockchain is that you can't change the record, that it does stay forever. So I can see how something like quantum computing can have an impact on that, but maybe I'm not seeing necessarily how the artificial intelligence would.
Well, then there are techniques you can use today where, yes, when you deploy a smart contract, it's forever, including any bugs that are in there can't be changed, and that's actually a good thing. So there are ways around that where you can use multi-layers of contracts, and some of which point to other contracts, and those can be, there are ways of using a proxy to change it. But so there are different, that's just one aspect of why smart contracts are dangerous. The other is that it's easy for developers to create bugs inadvertently when they're writing software, whether they're writing it for a blockchain solution or a conventional legacy solution. They're using the same legacy style of programming language, and that needs to change. And there's a lot of experimentation. So in the Ethereum ecosystem, there's a half a dozen initiatives trying to have better programming models for safer smart contracts. Maybe we should move to the next question.
Yeah, so the next question is a $1 trillion question, John. So I believe you said at the beginning that the blockchain market will be worth trillions of dollars. How many trillions and on what time frame? I think it's a great question, and please don't quote me on that, but I think that the best framework that we have so far is the framework that we've presented on slide. Let me go back here real quick. If it goes, screen sharing for sure. But the slide that we talked about, the Gartner predictions, and though I do believe that that was quite a conservative estimate, but the estimate is that blockchain is going to generate $3.1 trillion by 2030.
Right, and there's some others that are more aggressive with 3 trillion by 2025. And there's a distinction between business impact and the valuations that you see on coin market cap and other websites. So what we're looking at, or at least what I'm personally looking at, is more the real world solutions, to real world problems that have a real world business impact, as opposed to valuations of cryptocurrencies. So
right.
I have no idea what the aggregate valuation of cryptocurrencies will be, but that's not an interesting problem for me.
Well, I think that there is a framework to think about it. And the best way to think about it is in terms of the business problem that blockchain will solve. So I think a good example would be, Ray, you talked about it some time ago, a large network equipment manufacturer, Cisco, claims that 10% of its supply chain is fraudulent.
It's a gray market or counterfeit. So they have a 40 billion a year business, and 10% of that is 4 billion. So that's a real world problem with real dollars. So
the question is, if blockchain were to solve that, would that solution be worth 4 billion? Probably not, perhaps 10% of that, but that's sort of a way to gauge what the future value add can be in this space. All right.
I think Irfan also had maybe some additional comments. Irfan, are you there?
Yeah, thanks, Ray, and thanks, Kate. And I think that was more towards the first question. So traditionally, what I potentially would see is that semantics will play a big role. And there is especially when we are talking about blockchain network-based social systems, and that's where development in natural language processing itself could play a big part. So I do see certain intersection, but the technology is not ready there, or not there yet. As Ray say, like the language itself, like Solidity, is pretty rudimentary to begin with.
Good point. Thanks. We're at actually the end of our 60 minutes.
Well, let's take a
more questions. Yeah, I can continue on. Yes.
Yeah. So if we were to starting an exchange today, what platform or technologies would you use you were starting an exchange today?
Well, the thing is, the exchanges are not, they have, in that sense, they're not really blockchain. They're sort of related to blockchain, but they're sitting on the side. You can use, you know, they're centralized systems built with conventional technologies. So I would use proven enterprise grade technologies or cloud scale technologies. And one of the ones that's proven is Java. Another one is the Microsoft technology stack with C# and Microsoft SQL Server. And then there's newer ones that are more efficient that people are using, less so for solutions work and more for infrastructure, high performance infrastructure. Like Go, for example, Golang is used for high performance, but it's more infrastructure than solutions. So I would probably pick the proven systems, platforms that people are using to build large scale enterprise apps like Java and or the Microsoft stack. But again, that's nothing to do with blockchain per se. If I were building a blockchain solution like a decentralized identity system, a decentralized medical record, that would be done partly on-chain and partly off-chain. So it's a combination of centralized systems and decentralized blockchain. So I would use Ethereum and Solidity, even though Solidity is an imperfect language and I would like it for it to be obsolete. It's what we have today.
Yeah, so I think the ultimate question is, would we build a centralized exchange or would we build decentralized exchange? And I think what you're saying, Ray, for now, the centralized exchange might be a better option because the technology for
it's proven, it's performant, it can scale, and actually that relates to something we've seen in the enterprise sector. 90% of enterprise blockchain projects actually are centralized systems in decentralized clothing. They actually don't need blockchain to accomplish their goals, to meet their requirements, and you would actually be better off using conventional technology stack. You'd have better performance, more scalability, more maturity, more compatibility with your technical staff skills.
The problem, though, is that you have central point of failure, and when you're working with exchanges, you're working with hundreds of thousands or millions of dollars of people's money that can be stolen. So decentralization might make sense. So quickly to touch on portfolio, what portfolio looks like. Our current portfolio is comprised of 3 companies. Hedera Hashgraph is one of them, which is a next generation platform. Expansive, which is a blockchain-based platform for commodities like oil and gas, and a crypto algorithm trading platform. And in terms of 2019, we are looking at a variety of companies, starting from traditional exchanges that are raising at lower valuations today, to some of the platforms competing with Ethereum, to some of the applications that we think are low-hanging fruit, such as solving problems in the emerging markets, for example, with funding of farmers in agriculture. All right, so next question. Ray, do you want to take that one?
Yeah, so what do you think will accelerate enterprise adoption of blockchain? Will they use it as just security, or will they want to build their own gamified incentive systems? So yeah, a couple aspects to that. One is enterprises really need to understand the radically decentralized nature of blockchain technology, the value of immutability and smart contracts and so on. And it's really suitable for not within an enterprise and not for an enterprise to do business with its small number of trusted partners. It's really for business ecosystems that are distributed, that are fragmented, that are chaotic, that you have thousands of participants in an ecosystem, including your competitors. And these entities don't know each other, don't trust each other, don't know of each other, and yet need to do value exchange or other kind of business processes with each other. And supply chain is, I call it a $1 trillion opportunity for blockchain, because there's 40 trillion a year economy in supply chain globally, and even just 2.5% of that is $1 trillion. So blockchain can have an impact for these distributed, decentralized business ecosystems.
Yeah. So in the last question here, just for the sake of time, I'll go through real quickly. Can you guys touch on the trends on the DLT like DAGs? What are your thoughts and how do you see them competing with blockchains? Ray, do you want to start?
Yeah, I think there's a spectrum. One understanding that enterprises will go to is to see that there's a spectrum of centralization to decentralization, and you have centralized efficient systems that might be a single point of failure, to distributed databases that are still pretty much conventional, to going to private blockchains and consortium blockchains that are a small number of participants, but they don't necessarily trust each other. And you do have single points of weakness in, like, the network access control for a private blockchain is a single point of failure, but nevertheless they're more decentralized. And finally, you get to the fully decentralized public chains that are more immutable, more secure, but less scalable. So there are different kinds of trade-offs and attributes, and I think people will take away the rose-colored glasses and see the spectrum of tools available that's applicable for a range of solutions.
Sure. Yeah, just a quick note on that. Absolutely, I see this evolution happening technology-wise, away from the proof of work, high electricity consumption type of consensus algorithm, more towards something like a graph-based model. But what I want to mention is that it's not necessarily the best technology that is going to win. And we alluded to that earlier. Many VCs and many investors make an assumption that the best technology always wins. The best technology doesn't always win. It's the ones who are able to get developer adoption, enterprise adoption, and get people building real thing on that platform is going to win. And though graphs is sort of this new interesting innovation architecturally, and part of the investment thesis for us, we look at it as a part of the big picture. Other things is what traction do they have in the market, what is the success of their team, what is the track record, and how likely they're going to be able to get true enterprise adoption.
So yeah, if I would add to that, so I would rephrase what Kate just said as not the company with the best technology wins, it's the company with whoever has the largest developer ecosystem will win. And that doesn't mean you don't, and I'm not commenting specifically on Hedera, I'm just talking about small technology-centric startups that have cool technology. They can be worthwhile investments, more as acquisition targets for larger players and larger ecosystems than necessarily trying to build their own community. So again, that's not a comment specifically about Hedera, just seeing the experience of other ventures in other sectors. One other point here about will enterprises build their own gamified incentive systems with their own tokens? I think the gamification in enterprises was a fashionable topic 10 years ago before blockchain, and it was uniformly a failure. As from what I can tell, it only worked in certain specialized domains, but it's partly that the game design was transparently manipulative, and if people were not so easily fooled, so to speak. Token-based incentives, maybe there's, because they're real money and have real value, might have an impact, but I still see that it's going to be an outside player, an outside innovator that comes up with a new approach, not just technology-wise, but socially and culturally and psychologically, and I haven't seen that success in that area in the enterprise, so I don't expect it to happen for a while.
Yeah, so we have one more question. Apologies to those if we skipped a couple here. We're trying to keep up, but important one, what is Blockcelerate's investment thesis, and given the uncertainty in the space? Well, I don't necessarily think uncertainty is a bad thing. If there was a lot of certainty, then there would be a lot of growth or a lot of upside. So as investors, I think we can benefit a lot from the uncertainty by making bets. And our investment thesis is essentially is threefold. Number one, we actively track and invest in underlying building blocks of the infrastructure that will enable the next generation applications within the blockchain. So those would be the likes of Ethereum, but also include things like identity. I consider identity a true fundamental building block for blockchain. Number two is we're looking at application space, and specifically the low-hanging fruit, in my personal opinion, is disrupting the old-fashioned legacy businesses or making them more efficient. Likes of financial services, insurance, there's a lot of intermediaries where there's a lot of inefficiency, there's a lot of money to be made, and made pretty quickly before we get to the disruption of the disruptors, such as Facebook, the Ubers, which I think is going to take 5 to 10 years to get to. And the last bucket, if you will, that we're looking at is the ecosystem startups. And those don't have to do anything with blockchain per se, but they have to support the overarching ecosystem, such as the exchanges, such as the security platforms, the machine learning or artificial intelligence tools, etc. More on that, we actually have published 5 top predictions together with Ray a few months ago for blockchain for 2030. So what we'll do is we'll share a link to that article on Twitter. So if you want to find it, go to Twitter and find us at Bloccelerate. Great. Well, I think this was a productive hour. Thank you guys so much for joining, and feel free to ping us if you have any questions.
Thanks, everyone. Thanks for joining. Thanks, Kate and Ray.
Thank you, Irfan.
Giving us a great overview. Have a wonderful day. Happy holidays, everyone.
Happy holidays. Merry Christmas. Happy New Year.